The S&P 500 just hit another record high. The Dow is up. The Nasdaq is up. Financial media is doing what financial media does, running the same headline they've run roughly 300 times in the last 5 years. Markets surge to all-time highs. Investors cheer as stocks continue their historic run. The bull market shows no signs of stopping. Great, fantastic, wonderful news. So why does your grocery bill still feel like a small personal attack? Why does owning a house feel further away than it did 5 years ago? Why does your salary, which technically went up, somehow feel like it went down? If the economy is doing this well, why aren't you? Here's the thing nobody in financial media will tell you plainly. The stock market and your economic reality are not measuring the same thing. They haven't been for a long time. And the gap between them, between what the market is doing and what your life is doing, is not an accident, a temporary blip, or something that will sort itself out when the next administration gets in. It's a structural feature. And once you understand how it works, you'll never hear the phrase, markets at all-time highs, the same way again. None of this is complicated, but it is the kind of thing that certain people would very much prefer you didn't think too hard about. There are 3 reasons the stock market can keep hitting records while your financial life stays flat or gets worse. Each one is a layer deeper than the last. Most financial commentary gives you the first one and stops there, because the first one sounds reassuring. The second and third ones don't. By the end of this, you'll understand exactly what the market is actually measuring, who it's measuring it for, and why a booming stock market can be actively bad news if you're not in the right 10% of the population. Let's start with the most basic problem, which is that the stock market was never designed to tell you how ordinary people are doing financially. The S&P 500 tracks 500 large publicly traded companies. That's it. It tells you how the stock prices of those 500 companies are moving. It does not track your rent. It does not track your grocery bill. It does not track whether the job market is treating you well or whether your salary is keeping pace with the cost of living. It is a scoreboard for large corporations. And if you don't own a meaningful stake in those corporations, the score doesn't tell you anything useful about your team. GDP has the same problem. We use GDP as our main measure of economic health, how much output the country is producing. But GDP doesn't tell you who captures that output. An economy can grow while the gains flow almost entirely to a small group of asset owners, and the GDP number will look great. The country is producing more. It's just not producing more for you. Now, some people hear this and think, well, wages are up, so surely workers are getting their share. And it's true that nominal wages, the actual dollar amount on your paycheck, have been growing. In 2024, average hourly earnings grew around 4.5%, according to the Bureau of Labor Statistics. That sounds reasonable. But here's the problem. From January 2021 to mid-2025, according to Bureau of Labor Statistics data, average hourly earnings grew around 21.8%. Over that same period, the Consumer Price Index, the measure of what things actually cost, rose 22.7%. So cumulatively, for most of that period, your wages went up slightly less than prices did. You ran hard and ended up behind the starting line. But that's the surface problem, because even that comparison, wages versus consumer prices, is actually measuring the least important gap. It's time to learn how it actually works, to find out why the gap that really matters isn't between your wages and groceries. It's between your wages and everything else. Sounds unfair, right? Well, it gets worse. Here's the number that reframes everything. According to Federal Reserve data, the top 10% of American households own approximately 87% of all stocks and mutual funds. The bottom 50%, half the country, owns roughly 1%. Let that sit for a second. When the market goes up 20% in a year, 87% of those gains flow to the wealthiest 10% of households. The Robin Hood investors, the people with a modest 401k, the people who are technically in the market, they participate, but they don't move the needle. According to the Federal Reserve's Z1 financial accounts, in 2024, households made net stock purchases of around $100 billion. Listed corporations, buying their own stock back, did over $625 billion worth of net buying. Companies were buying 6 times more of their own stock than actual individual investors were. Now, stock buybacks are worth understanding for a second, because they are one of the most important things happening in markets right now that almost nobody talks about plainly. When a company buys back its own shares, it reduces the number of shares in circulation, which mechanically pushes the price of remaining shares up. The company's underlying business hasn't improved. It hasn't hired more people, built a better product, or grown its revenue. It just spent money making its own stock price look better. Over $1 trillion was spent on buybacks in 2024 alone. That's the single biggest driver of the market going up. Not economic growth, not productivity, not innovation. Companies spending their cash to inflate their own valuations. And the people who benefit from that are the people who own the most stock, which, as we just established, is not most people. There's a term financial media loves: the democratization of investing. The idea that apps like Robin Hood and low-cost index funds have opened the market up to everyone. And technically, that's true. 62% of Americans now own some stock, a 20-year high according to Gallup. But owning stock and owning enough stock to benefit meaningfully from a bull market are very different things. If you have $5,000 in a 401k and the market goes up 20%, you made $1,000 before tax. If you have $5 million in equities and the market goes up 20%, you made $1 million. You're both in the market. You are not having the same experience. Now, here's the part that closes the trap. And this is the part that almost never gets said out loud. A booming stock market doesn't just fail to help people who don't own assets. It actively makes their lives more expensive. Here's how. When asset markets boom, when stocks go up, when returns are strong, that capital looks for more places to go. Wealthy investors and institutional money don't keep all of it in stocks. They diversify into other asset classes. And the most obvious one, the one that affects ordinary people most directly, is real estate. Housing in the United States has stopped being primarily a place where people live and started being primarily a financial asset, competing with other financial assets for capital. When stock market returns are strong and money is looking for a home, some of it flows into property, both residential and commercial. That additional demand pushes prices up, and you're not competing with other families who want to live in that house. You're competing with capital that wants a return. That is a competition you are structurally not equipped to win on a salary. The result is what we've watched unfold over the last 2 decades. House prices have outpaced wage growth by a significant margin. The median home price in America has roughly tripled since 2000. Median wages have not tripled. The gap between what you earn and what assets cost keeps widening. Not because the economy is broken, but because the economy is working exactly as designed for the people at the top of it. Your salary is indexed at best to consumer price inflation, the cost of groceries, gas, rent, the slowest growing pile. The things you want to own, houses, financial security, assets that compound over time, are priced against investment returns. You're running a different race, at a different speed, against opponents with a completely different engine. And so, when the market hits a record high, what's actually happening is this. The people who own the market are getting wealthier. That wealth gets recycled into other asset classes. Those asset classes get more expensive. And the gap between people who own assets and people who don't, between the people whose net worth goes up automatically while they sleep and the people whose net worth depends entirely on their next paycheck, gets a little wider. The market isn't broken. It's doing exactly what it was built to do. It's just not built for you. Now, the tragic part of all this isn't that nobody knows. Plenty of people know. Economists have been tracking the labor share of income versus the capital share of income for years. The Fed publishes the equity ownership data publicly. None of this is hidden. It's just not what gets led with when markets hit a new high. Because for the people who own the market, a record high is genuinely great news. And those tend to be the people who run financial media, sit in government, and get quoted as expert voices on the state of the economy. The system doesn't need a villain. It just needs incentives that point in one direction, generation after generation, until the gap becomes the background noise of everyone's financial life. Something you feel, but can't quite name, because the scoreboard on the news keeps telling you things are going great. Nothing about this creates any natural pressure to fix itself. But now at least you know what the scoreboard is actually measuring. Don't forget to like and subscribe to keep on learning.